Welcome to the research desk. We are confronting a really unique structural anomaly in public markets today.
We absolutely are.
Imagine analyzing a single ticker symbol, but you are seeing two entirely different economic realities operating simultaneously. To one faction of the market, this ticker represents a deteriorating automotive manufacturer that is actively losing a global price war.
Mm-hmm.
And to another, it represents the most important artificial intelligence, robotics, and autonomous platform on Earth, which is, currently in its incubation phase.
Exactly. So the central tension of our briefing today really revolves around one highly specific question. Can the present automotive business survive long enough and generate enough free cash flow to finance the bridge to a fully priced autonomy and robotics future?
Right. That is the core issue.
And my position is that the severe margin compression we currently observe in the automotive segment is actually a calculated transitional cost. It is basically the necessary price of building an irreplaceable AI and data infrastructure that will ultimately secure a global high-margin software monopoly.
Well, the data tells a completely different story.
Let's hear it.
My position is that the company is suffering from structural, irreversible business degradation. The core automotive business is fundamentally broken, not just experiencing a temporary cyclical weakness.
But the market valuation.
The market is currently valuing this entity with a price-to-earnings ratio consistently exceeding 50x. By paying that multiple, the market is entirely prepaying for an artificial intelligence future, while deliberately ignoring undeniable, verifiable data. Data that shows demand destruction, competitive convergence, and severe margin collapse in the core business.
Yeah, the valuation is certainly forward-looking.
It is a company funding an unproven dream that may never arrive before the foundational manufacturing business falters. Valuation is the core battlefield here, and the present reality just no longer supports the future narrative.
Then we start with the verifiable data. We will not debate the numbers themselves, right? Our objective is to debate the strategic mechanics driving those numbers. The baseline of automotive weakness is documented, and we really must look at the exact trajectory of the margin collapse to understand what is actually happening.
Go ahead.
In 2021, the automotive gross margin stood at an industry-leading 26.8%. That was obviously a peak pricing environment. By 2022, it contracted slightly to 25.9%. In 2023, the floor fell out, dropping to 18.2%, and by the first quarter of 2024, it reached 17.4%.
A massive drop.
It is. And alongside that margin compression, we're observing the first annual revenue decline in the company's history. Fourth quarter deliveries are down 16%.
Right.
Regional data confirms the contraction too. Vehicle registrations in France dropped 36.8%. And looking at the most critical electric vehicle market on the planet, BYD outsold Tesla 2-to-1 in China in January 2026.
Exactly.
So you view these facts on the ground as the end of the growth story. I view them as the mathematical reality of transitioning a hardware installed base into a software network.
You cannot simply wave away a drop from a 26.8% margin to a 17.4% margin as a transition. Those figures represent the physics of manufacturing reality asserting themselves against a narrative.
Well, price cuts are a choice.
But in a capital-intensive industry, cutting prices to that degree completely destroys your operating leverage. Heavy manufacturing requires massive fixed cost absorption. When you build a multi-billion-dollar gigafactory, the depreciation and operational costs of that facility are fixed.
Sure, the depreciation schedules are heavy.
Right. And the only way to achieve a 26.8% margin is to maintain high volume and supreme pricing power. When you slash prices just to maintain volume, the revenue per unit falls, but your fixed costs remain rigid. That is the mechanical reason the margin has collapsed to 17.4%. You are bleeding cash to move metal.
I acknowledge the cash burn on the hardware side.
However, any serious bearish analysis must also acknowledge the non-trivial advantages the company still retains. I am not suggesting the company is worthless.
Well, that's good to hear.
The global supercharger network remains an undisputed hard asset moat.
the competitors, including legacy automakers, now rely upon. The energy storage business demonstrates verifiable, high-margin growth. And most importantly for your platform thesis, the installed base of millions of vehicles generates massive quantities of real-world driving data.
Exactly. Petabytes of it.
These advantages exist, but the critical error investors make is assuming that a compelling strategic narrative guarantees commercial success. We have a direct historical precedent for this exact company failing to translate a grand, capital-intensive vision into valuation reality.
You are going to bring up SolarCity.
I am. Look at the SolarCity acquisition.
The SolarCity precedent is frequently cited by the bear camp, but applying it to the current artificial intelligence transition really demonstrates a misunderstanding of how different technologies scale. Detail the exact mechanics of the SolarCity failure as you see them, and I will explain why the underlying mathematics of that failure just do not apply to autonomy.
Fair enough. In 2016, the company acquired SolarCity for approximately $2.6 billion. The strategic narrative presented to the market was undeniably compelling at the time. The acquisition was framed as the ultimate integration of solar generation, battery storage, and electric transportation under one unified clean energy umbrella.
It was a great pitch.
It was. The market was sold a vision of a vertically integrated energy ecosystem where the consumer generates power on their roof, stores it in their garage, and drives it to work. The narrative justified the premium valuation. However, the operational reality diverged sharply from the pitch deck.
Because of the execution on the solar roof.
Yes. They introduced the solar roof, a product designed to replace traditional roofing tiles with integrated solar cells. It was supposed to revolutionize the industry. Instead, deployment severely lagged all internal and external expectations. Standard solar installations plummeted from the volume levels achieved during the independent SolarCity era.
Right.
The entire solar segment failed to become the valuation engine that the initial vision implied. Why? Because installing custom glass solar tiles requires bespoke permitting for every single municipality. It requires specialized roofing labor. It is dependent on local weather conditions and complex, non-standardized supply chains.
It was a physical slog.
Exactly. The strategic lesson here is paramount. Markets will enthusiastically fund a grand vision initially, but they will eventually demand operational proof. The SolarCity chapter is the exact precedent investors must study before automatically assuming that the robotaxi and artificial intelligence adjacencies will deliver where solar integration comprehensively failed.
Your analysis of why the solar roof failed is operationally correct. It failed because hardware scales linearly, and physical construction in the real world is beholden to friction.
Massive friction.
Right. You must manufacture, permit, and physically install every single solar roof. If you want to double your revenue, you must double your labor force and double your material input. But you are using a hardware failure to predict a software outcome.
It is a capital allocation failure.
But the failure of a physical adjacency is not predictive of a software and artificial intelligence transition because software scales exponentially. Autonomy and artificial intelligence represent zero marginal cost distribution.
Eventually. Assuming it works.
Currently, the company is spending billions on compute clusters to train the full self-driving neural network. That requires massive capital expenditure upfront. But understand the mechanics of what happens the moment that neural network achieves functional, regulatory-approved dominance.
Which is a huge if.
Pushing that software update over the air to millions of vehicles costs exactly nothing. You do not need to pull permits. You do not need specialized roofing labor. You do not need raw silicon.
I understand the software economics.
The SolarCity precedent measures the extreme difficulty of physical construction and linear scaling. The current transition to full self-driving measures the difficulty of compute scaling and data ingestion. Once the compute problem is solved, the distribution is instantaneous and virtually free.
The distinction between linear hardware scaling and exponential software scaling is mathematically correct, yes, but it ignores the fundamental issue of capital allocation and market patience.
How so?
The market gave the company the benefit of the doubt with the $2.6 billion SolarCity acquisition in 2016 precisely because the core automotive business was entering a hypergrowth phase. The introduction and scaling of the Model 3 provided an enormous valuation halo.
The auto business was booming, yeah.
The core business subsidized the solar failure. Investors ignored the lack of solar deployments because automotive revenue was compounding. Today, the core automotive business is deteriorating. It cannot subsidize a prolonged multi-year failure in the autonomy division. You are relying on the zero marginal cost distribution of software that does not yet exist, funded by a hardware business that is actively losing its profitability.
That brings us directly to the platform thesis, which provides the structural framework for the bullish perspective and explains why the current hardware profitability is actually secondary. Traditional automotive metrics like tracking quarter-over-quarter gross margins on physical vehicle sales fail to capture the true enterprise value because they categorize the company incorrectly.
Because you think it's a tech company.
Evaluating this company as a legacy automaker is like evaluating Apple in 2008 based solely on the profit margin of the physical aluminum in an iPhone, while completely ignoring the App Store ecosystem it was actively building. The framework requires viewing the company as a technology platform, prioritizing data acquisition and installed base expansion above all else. There are 4 pillars to this argument.
Lay out the 4 pillars.
First, the framing. It is a tech platform, not a car maker. The vehicle is simply the physical node in a digital network.
Second, the data moat,
The fleet generates petabytes of real-world driving data,
which competitors are also starting to collect.
not at this scale. To solve generalized autonomy using end-to-end neural networks, you cannot rely on millions of lines of heuristic, rules-based C++ code. You cannot program a car to handle a plastic bag blowing across a dark highway in the rain using if-then statements.
Right, edge cases.
You must train the neural network with massive amounts of video data showing how human drivers react to edge cases. Competitors might match the physical hardware of a vehicle, but replicating years of edge case driving data collected from millions of cars across the globe is nearly impossible.
Okay, what's the third pillar?
Third, software unit economics. Transitioning from selling metal boxes at a 17.4% margin to selling high-margin recurring software subscriptions fundamentally alters the margin profile of the entire enterprise.
And the fourth?
Fourth, tactical margin compression. This is where the 17.4% gross margin becomes a strategic weapon rather than a weakness. By lowering prices aggressively, the company expands its installed base. The expanded installed base generates more data. That data trains the neural network faster, hastening the arrival of the software monopoly.
So losing money is actually winning.
Short-term hardware margin sacrifices are strategically rational to secure long-term high-margin software monopolies. This dynamic is not unprecedented. The Amazon AWS analogy is the precise historical parallel to what we are witnessing today.
The Amazon analogy is the most heavily relied upon crutch in the bullish narrative. Walk through the exact parallel you see, and I will dissect where the structural mechanics of that comparison completely break down.
In 1999, Amazon was widely derided by Wall Street analysts. The company was hemorrhaging money and possessed no clear path to profitability in its core retail book-selling business. Financial media frequently referred to it as Amazon.bomb.
I remember it well.
The prevailing consensus was that Jeff Bezos was running a low-margin retail operation disguised as a technology company, and that traditional brick-and-mortar retailers would eventually crush him. Yet, Bezos ignored the relentless demands from institutional investors for short-term retail margins.
He did.
Instead, he relentlessly directed capital into building irreplaceable infrastructure. He invested billions into fulfillment centers, sophisticated logistics networks, and massive back-end computing technology. The market questioned this capital allocation severely. Investors could not reconcile the valuation of an unprofitable retailer spending billions on server racks.
Because the immediate return was zero.
Right. But this infrastructure incubation phase was purposeful. The internal mandate was to build a system so robust that no competitor could ever match the underlying compute power. This culminated in the 2006 launch of Amazon Web Services, AWS.
Which changed everything.
AWS essentially rented out the excess server capacity Amazon had built to run its own retail operations. AWS reshaped the entire global technology industry, introducing cloud computing and generating unprecedented high-margin recurring revenue. Today, AWS accounts for the vast majority of Amazon's operating profit. while the retail business operates on razor-thin margins.
True.
Those who understood that Amazon was building digital infrastructure rather than just selling physical books were rewarded enormously. The margin compression we see in the automotive business today, falling to 17.4%, is the exact equivalent of Amazon in 1999. It is not a failure of manufacturing, it is the calculated infrastructure building phase.
You think the auto division is just the book business?
The company is spending heavily on the Dojo supercomputer, NVIDIA H100 clusters, and data ingestion pipelines. The market is punishing the auto margins just as it punished Amazon's retail margins. But the true value lies far beyond the physical product. Full self-driving and the robotics platform are the AWS of this decade.
The narrative symmetry of the Amazon AWS analogy is seductive, I'll give you that. But it fundamentally misrepresents the condition of the underlying financing mechanism. You are mapping an infrastructure success story onto a structurally failing core business.
How is it failing if it's expanding the installed base?
Let us look at the exact mechanics of Amazon between 1999 and 2006. When Amazon was incubating AWS, its core retail revenue and market share were expanding rapidly. Retail was unprofitable, yes, because they were reinvesting every dollar, but the top-line growth was explosive.
Right. Revenue was growing.
The consumer adoption curve for e-commerce was aggressively upward. Amazon incubated its future monopoly from a position of expanding core market dominance. They were capturing more of the total addressable market every single quarter.
Well, the current company is also capturing market share relative to internal combustion engine vehicles over a multi-year horizon.
But not relative to electric vehicle competitors, which is the actual benchmark. The company we are analyzing today is attempting its technological transition while its core automotive business is actively contracting. Revenue's declining. Deliveries are down 16%.
That's cyclical.
The margins are collapsing not purely by choice, but because market forces and superior competitors are dictating it. If Amazon's book sales had dropped 16% in 2003 while they were trying to fund AWS, the market would have pulled their access to capital, and AWS would never have launched. A company can survive margin compression if volume is exploding. A company cannot survive severe margin compression while volume is simultaneously contracting.
But the price cuts driving the 17.4% margin were initiated internally to stimulate demand, secure market share, and protect the data pipeline. You cut the price of the hardware to ensure the node enters the customer's driveway, guaranteeing the future software revenue stream. That is a proactive, strategic maneuver, not a reactive surrender.
The competitive data proves otherwise. Let us move to the structural bear arguments and examine the demand destruction dynamic. We are not looking at a company proactively sacrificing margin. We are looking at a company having its margin forcibly extracted by a superior manufacturing ecosystem.
You're talking about China.
Look at the exact metrics regarding competitive convergence. BYD's global electric vehicle market share rose from 10.5% in the first quarter of 2023 to 19.3% in the first quarter of 2024. That is an explosive, structural capture of market share by a direct rival. This proves that margins are being competed away.
BYD operates in a protected domestic market with heavy government subsidies. Their global capture is primarily in emerging markets where the purchasing power parity dictates lower-cost vehicles, an area Tesla has strategically chosen to deprioritize in favor of autonomy development.
BYD's advantage is not merely geographic. It is structural and technological. BYD is a vertically integrated competitor that manufactures its own battery cells, specifically lithium iron phosphate, or LFP batteries, which are cheaper, highly durable, and rely on materials completely controlled by Chinese supply chains.
Yes, they have a battery cost advantage.
They own the ships that transport their vehicles globally. They control the refinement of the raw materials. The decline to a 17.4% gross margin for our subject company reflects aggressive price matching forced by these vertically integrated Chinese competitors.
It's a price war, certainly.
It is compounded by slowing overall market demand growth for electric EVs and an aging product lineup that has not seen a meaningful high-volume refresh in years. If margins fall because a company chooses to invest in data center infrastructure, that matches your Amazon thesis. But if margins fall because the physical product is losing its differentiation and pricing power against a competitor with superior manufacturing economics, that is a fundamentally different and significantly more dangerous reality. You cannot fund the Dojo supercomputer if BYD prices you out of the European and Asian markets.
The competitive convergence in physical manufacturing is acknowledged. BYD builds a highly efficient metal box. But you are assuming the core product is merely the vehicle.
It currently is the vehicle.
But strategically, the core product is the autonomous capability. The hardware is just a distribution mechanism. BYD does not possess the compute cluster to train a generalized end-to-end neural network. They do not have the petabytes of Western Hemisphere driving data required to replicate full self-driving.
They might not need it yet.
They're building cheaper smartphones before the App Store exists. Once the software layer is activated, the cost of the underlying hardware becomes irrelevant to the enterprise valuation.
They do not need to replicate full self-driving to destroy the automotive margins today. By commoditizing the hardware, they starve your company of the exact cash flow required to build that software layer. Furthermore, the demand destruction is not merely a function of foreign competition and battery economics.
What else is driving it?
It is heavily driven by brand and governance risk. We must examine the founder-driven brand damage, and to understand the mechanics of this, we really must look at the Bud Light boycott dynamic as a structural parallel.
Comparing a fast-moving consumer good, a highly substitutable beverage, to a $50,000 high-capital technology purchase often breaks down under scrutiny. The consumer decision matrices are entirely different.
The underlying mechanics of consumer behavior, brand alienation, and addressable market contraction are identical, regardless of the price point. In 2023, Anheuser-Busch InBev faced a catastrophic consumer boycott over a single marketing decision regarding Bud Light.
The Dylan Mulvaney promotion?
Yes, the brand engaged in a specific promotion that deeply offended its core demographic. That singular action triggered a targeted consumer backlash. The financial result was instantaneous and brutal. The boycott cost Anheuser-Busch InBev over $27 billion in market capitalization in a matter of weeks.
It was a massive hit to the stock.
And the boycott was not just about individual consumers choosing a different beer, it fundamentally altered distribution networks. Distributors lost shelf space, and the market share permanently shifted to rivals like Modelo. The brand equity, built over decades, was incinerated by a failure to understand the identity politics of the core consumer.
Right.
The current trajectory of the company we are discussing is remarkably similar, but potentially more damaging because the alienation is structural, continuous, and driven directly from the top.
Detail the mechanics of how you see that applying to vehicle purchases.
The CEO's escalating political involvement, the high-profile integration with the Department of Government Efficiency, or DOGE, and the constant polarizing public engagement on social media platforms are actively alienating the core demographic of electric vehicle buyers.
You're saying the progressive early adopters are leaving.
Historically, early adopters of electric vehicles skewed heavily toward environmentally conscious, progressive consumers. The CEO's current public posture operates in direct opposition to that demographic. When a consumer buys a vehicle, they're not just buying transportation. They are buying a signaling asset. They are projecting an identity.
Sure, cars are status symbols.
Macroeconomic weakness or interest rate pressure. It is empirical proof of demand destruction driven by brand toxicity in a key market. When a founder actively damages demand for his own core product to pursue a parallel political agenda, the total addressable market shrinks permanently. You cannot achieve the volume necessary to train your neural network if half the addressable market refuses to be seen in your product.
Your analysis of the consumer behavior mechanics is precise, but I challenge the permanency of that brand impairment. You are analyzing the brand sentiment through the lens of a hardware identity purchase.
Because that's what it is today.
I question whether brand sentiment driven by political polarization is a permanent impairment or merely a temporary headwind that will be entirely erased by technological utility. Let us apply the platform thesis to this brand damage. If the company achieves a functional, verified robotaxi monopoly, brand sentiment becomes instantly irrelevant.
Irrelevant?
Think about the mechanics of ride-sharing today. When you open the Uber app, you do not check the political affiliation of the CEO of Uber, nor do you care about the brand of the car that arrives, provided it is clean and safe.
I suppose that's true.
If a consumer requires transportation from point A to point B, and the autonomous network offers that service at 50% of the cost of a human-driven Uber, the consumer will take the ride. The political opinions of the CEO do not factor into a utility transaction driven by absolute cost supremacy.
You're talking about a pure commodity service.
Exactly. The Bud Light analogy assumes the product remains a highly substitutable consumer identity purchase. A robotaxi monopoly transitions the product into an unsubstitutable public utility. If you control the cheapest, safest transportation network on Earth, the consumer has no alternative to substitute.
That requires the robotaxi monopoly to actually exist, which currently it does not. The market is pricing the stock as if that transition from identity purchase to public utility is a mathematical certainty. Meanwhile, the brand destruction is happening right now, eroding the exact cash flows needed to fund the compute required to reach that future.
The cash flows are lower, but they are still positive.
Which brings us perfectly to the structural metaphors that define this company's current reality. You cannot discuss the enterprise structure today without examining the double helix.
The biological double helix analogy is the most precise framework for understanding how the market currently prices this entity. In molecular biology, a double helix consists of two distinct strands winding around a central axis, held together by complementary base pairs.
Right, adenine and thymine, cytosine and guanine.
Exactly. We must view this company as a structural double helix. The two strands are the automobile manufacturing business and the artificial intelligence and autonomy business. Currently, these two strands are twisting in entirely opposite directions.
Radically opposite directions.
The automobile manufacturing strand is deteriorating. Margins are compressing to 17.4%. Global market share is ceding to BYD. European registrations are falling, and revenue is contracting. The physical reality of the business is shrinking.
Yes.
Simultaneously, the artificial intelligence strand is highly aspirational and accelerating in technological capability. The release of Full Self-Driving version 12 demonstrated a massive leap in end-to-end neural network capability. The compute capacity is expanding exponentially, but critically, that AI strand remains entirely unmonetized at scale.
And what holds those two diverging strands together? If the auto business is failing and the AI business makes no money, why hasn't the valuation collapsed to legacy auto multiples?
They are held together only by the market's willingness to believe that both can coexist within a single valuation framework. The investor base provides the complementary base pairs. Institutional belief provides the structural integrity.
It's pure faith.
As long as the market believes the AI strand will eventually monetize, consume the auto strand, and generate software-level margins, the helix remains stable. The high multiple is the market pricing in the probability of the AI strand succeeding.
But if that market faith breaks, the helix unwinds violently. Institutional belief is not a permanent asset, it is highly conditional. This requires us to introduce the financing bridge analogy. The double helix explains the valuation, but the financing bridge explains the operational reality.
The cash flow logic.
The financing bridge represents the strict cash flow logic of the company. The central thesis is that the free cash flow, the balance sheet strength, and the investor confidence generated by the present automotive business serve as a literal bridge. The destination at the exact end of this bridge is the unmonetized artificial intelligence and robotaxi future.
Correct. The physics of AI development require massive, continuous capital. The automotive business funds the capital expenditures required for compute power. Selling cars at a 17.4% margin, while painful compared to 2021, still generates the billions required to fund the Dojo supercomputer.
Billions in CapEx, yes.
It funds the massive data center expansions. It buys the tens of thousands of NVIDIA GPUs required to train the neural networks. The hardware business is the toll collected to build the bridge.
Exactly. But a bridge must be structurally sound to carry heavy freight. The bear thesis is that the foundation of the bridge, the automotive margins and delivery volumes, is cracking under the weight of competition and brand destruction. You are asking investors to cross a decaying bridge to reach a destination that has been perpetually deferred since 2016.
The timelines have slipped. I grant you that.
Every year, autonomy is promised as being just 12 months away. Every year, the complexity of edge case driving pushes the timeline back. Every year, solving the problem requires exponentially more compute, which requires exponentially more capital. The time dimension is the ultimate wildcard here. We are looking at a rapidly shrinking runway.
Elaborate on the specific mechanics of this shrinking runway. How does the time dimension actively threaten the platform thesis?
The runway shrinks through a mathematical squeeze. The core automotive business is producing less excess cash because of the price cuts required to fight BYD and stimulate demand amidst brand alienation.
Okay, the cash inflow is reduced.
Simultaneously, the capital requirements for AI are increasing as the models require more data and compute to solve the final fraction of a percent of driving edge cases. Less cash coming in, more cash required to go out. Furthermore, this timing risk is heavily compounded by the CEO's divided attention.
Executive bandwidth.
Capital allocation is not just about financial resources, it is about executive bandwidth. Every single quarter, the CEO spends heavily engaged in political ventures, managing social media platforms, or directing top-tier engineering talent and compute resources toward parallel companies like XAI is a quarter where the financing bridge shortens.
That is a legitimate concern for institutional shareholders.
The destination of autonomy remains deferred, but the structural integrity of the automotive cash flow weakens daily. You cannot build the most complex, safety-critical software system in human history with fractured executive focus, especially while your core manufacturing competitors are operating with lethal, singular discipline. BYD is not building social media algorithms. They are optimizing battery cell chemistry 24 hours a day.
Your analysis of the time dimension and the cash flow squeeze is accurate, but it naturally introduces the wild card scenario. This scenario completely invalidates the bear case if achieved, and it proves why the market maintains the premium valuation. We must define the autonomy proof of concept window.
Okay, let's look at the window.
The timeline for the bridge to hold is not infinite, but it does not need to be. The critical window is the next 12 to 18 months. The software does not need to be perfect everywhere on Earth. It only needs to be proven economically viable somewhere.
Define the exact parameters of this proof of concept. What constitutes structural proof?
The wildcard scenario is a verifiable, revenue-generating robotaxi deployment in a major, complex, regulatory market, specifically Austin, Texas, or San Francisco, California, executed within the next 12 to 18 months.
So, an actual commercial launch.
Right. We're not talking about a closed-course demonstration or a staged presentation on a studio lot. We're talking about a consumer opening an application on their phone, summoning a vehicle without a human driver, completing a standard route through urban traffic, and processing a financial transaction.
Unsupervised autonomy in a geofenced area.
If this specific event occurs, it fundamentally alters the financial reality of the company. It provides auditable, high-margin software revenue. It provides verifiable safety data that can be handed to regulators in other states and countries to accelerate deployment. Most importantly, it completely validates the platform thesis.
It would change the narrative, yes.
The moment that first commercial transaction clears, the entire valuation debate ends. The market will cause a massive upward re-rating of the stock because the zero marginal cost software narrative will be proven mathematically true. The bridge will have successfully reached the destination, and the deteriorating margins of the hardware business will instantly be viewed as irrelevant legacy metrics.
If that exact scenario happens within 18 months, you are entirely correct. The upside is enormous, because the market, despite the high 50x multiple, has not fully priced the cash flow dynamics of a global working autonomous fleet replacing human labor. But we must weigh probabilities based on historical performance.
The history of missed deadlines.
Right. If that 12 to 18-month window closes without a commercial deployment, if timelines slip yet again due to regulatory hurdles or unsolved edge cases as they have consistently since 2016, the market's patience with the financing bridge will evaporate. Institutional investors will demand a return to automotive fundamentals.
Which would be catastrophic for the multiple.
The re-rating downward will be violent because the core automotive business alone cannot mathematically support a 50x price-to-earnings multiple when its margins are 17.4% and falling, and its revenue is declining. It will be repriced as a struggling legacy automaker.
This brings us to the ultimate synthesis of our briefing. We must summarize the central tension that every portfolio manager must resolve. The question that dictates all capital allocation regarding this ticker is whether the company is currently Amazon in 1999 or SolarCity in 2016.
That is the definitive framing for the entire debate. If it is Amazon in 1999, the financing bridge holds because the underlying strategic infrastructure is built correctly. The billions spent on compute are the equivalent of Bezos building fulfillment centers. The eventual monetization of the AWS equivalent, robotaxis and licensed autonomy, will generate so much high-margin cash flow that it will dwarf the current margin pain in the hardware division.
Right.
But as we established in the underlying mechanics, Amazon built AWS while its core business was aggressively expanding its market share. Tesla is attempting to build its platform, while its core business is contracting under pressure from BYD.
And if the reality aligns closer to SolarCity in 2016, the bridge cracks because the operational proof fails to materialize in the real world.
The grand vision of the clean energy umbrella sounded perfect in a pitch deck, justifying a massive acquisition premium. But the physical deployment of the custom solar roofs proved financially unviable due to linear hardware scaling constraints.
And the market eventually stopped funding the vision.
Right. They demanded auditable revenue and punished the valuation. If autonomy hits a regulatory or compute wall, the same punishment awaits.
Which forces us to deliver the direct, chief strategist takeaways for portfolio construction based on these mechanics. Number 1. Do not treat this stock as a conventional technology equity or a conventional automotive equity. Traditional valuation models, like discounted cash flows applied to vehicle deliveries, will fail to capture the downside risk or the upside potential. It breaks standard models.
It is a hybrid entity whose valuation depends entirely on which strand of the double helix dictates market psychology at any given moment.
Number 2. Size your exposure for the extreme uncertainty of the outcome. Whether your internal models skew bullish toward the AI platform or bearish toward the structural decay, the most common institutional error is oversizing the position based on ideological conviction. The range of potential outcomes is wider here than for almost any other large-cap equity in the public market.
You're either going to zero or to the moon, effectively.
You are underwriting either a global software monopoly or a collapsing auto manufacturer. Direct exposure should remain a small, single-digit percentage of any portfolio until one narrative decisively and permanently wins.
Number 3, monitor the bridge, not the destination. Retail investors obsess over robotaxi headlines, AI presentations, and promises of humanoid robots. Strategic investors must focus intensely on the structural integrity of the bridge. You must track automotive gross margins to ensure they do not dip below operating expenses.
Keep an eye on the cash flow.
You must track quarterly delivery volumes, and you must monitor regional brand sentiment metrics in Europe and China. If the automotive cash flow dries up, the bridge collapses and the AI destination ceases to matter because they will not be able to fund the compute required to reach it.
Number 4. If your analysis leads you to the bearish structural conclusion based on BYD's expansion or brand destruction, utilize options rather than naked short selling. The extreme volatility of the narrative, combined with the potential for the wild-card robotaxi deployment in Austin or San Francisco, makes directional, unhedged bearish bets mathematically reckless.
The short squeeze risk is immense.
A single regulatory approval could trigger a massive short squeeze. Utilize defined risk structures
like put spreads, to capture potential derating without exposing your capital to infinite upside risk.
Number 5. If you hold the bullish platform thesis and believe in the zero marginal cost software economics, demand absolute operational proof before adding to your position. The time to increase capital allocation is after the autonomy thesis produces measurable, auditable commercial results. Wait for the transaction to clear in the app. Being early on a broken bridge is financially indistinguishable from being entirely wrong.
The stakes are absolute. The margin for error has been entirely consumed by the rapid deterioration of the automotive segment. We are looking at a binary financial outcome based entirely on the speed of software development versus the speed of manufacturing decay.
Tesla is a financing bridge between a business that exists and a business that does not yet produce auditable revenue.
This is the research desk officially signing off.